Hey everybody, Signet here with the Bullish Bears, and in this video we're going to talk about Vega. Vega is a rate of change to the underlying option value when volatility moves. Okay, I know that might sound a little complicated at first, but let's focus on the mark. And we're going to use the May 9th options, 2 days from expiration. The mark for the options at the money, one strike in and one strike out, is the 410, 411. We want to look at the implied volatility value for those options and then look at the Vega value for those options. Notice it's going to be the same this time. So the 410 has a Vega of 13. And that tells us that when implied volatility changes, the rate of change in the Vega will be applied to the option. All right, I know that might sound a bit much, but we got to think about how much our options are going to change if volatility goes up or down. That's really what we're trying to evaluate. In a normal market, under normal conditions, implied volatility, as it's stated within its average here on the options chain, generally runs from a high value down here, lower and lower as we get closer and closer to expiration. That's how a normal market runs, right? And we're talking about average implied volatility. So these average implied volatility values come from taking all of the out-of-the-money options in their aggregate, adding them all up, and then getting an average from that, and that's where these values come in. Okay, so that's the implied volatility average for the series that we're thinking about trading. We can come in and we can examine these different days to expiration, and we can see their aggregate implied volatility values. But when we're talking about Vega, we're actually not referring to the aggregate implied volatility. We're trying to focus on one specific strike, and that strike's volatility. So if we're looking at the 420 for an example, it has a Vega value of 40, and it has an implied volatility value of 24. So if price in the underlying stock, say SPY, if SPY goes up $1 or if it goes down $1, that won't change the Vega. What will change the Vega and how much those options will gain or lose based on volatility values is each strike's implied volatility. All right, so the 420 has a 24 vol. The 418 has a 24.36. The 412, if we just drag that across, has 25.48. Each change in there will change how much. That's where we look at Vega. All right. Now, another thing that we want to look at when it comes to Vega is an understanding of where's the greatest amount of Vega located. Is it really far out in time? So if we go out to December 20 of 2024, 958 days in the future, and we were to look at the Vega value, we could identify options near the money and at the money and out of the money and we can ask a simple question. First, where's the greatest amount of Vega? Where's that located? Is it near the money, in the money, or out of the money? So we come in and we look at these Vega values, and we can see 258 right there. That's the highest concentration of Vega value, $2.58. Now on either side of that, higher and lower, is 257. So this is another bell shape, right? Where we start with a low value in Vega, and then when we get closer to the money, it gets bigger. And then once we get on the other side of that, we start going the other way, it decreases again, and that creates the bell curve again. And the greatest amount of Vega is going to be within that curve near the money. So if you're trying to put on a trade that will benefit from a volatility crush, or perhaps you're putting on a trade that will benefit if volatility rises, then we can look at this and recognize where the greatest amount of Vega is, because Vega will be applied to that option's price, either as a positive or a negative, right? Because volatility can come in to the market, but it can also go out of the market. We're looking at an implied volatility this far out of 2159, right? But notice that number gets higher and higher and higher the deeper into the money we go, right? And that creates a little bit of a distribution pattern that looks a lot like a P shape, right? So it looks more like that. Maybe even without the curve in it, it just looks a bit like that, right? Because that would be where the highest values are, and this would be where the lowest values are. So when we're looking at this and we want to have a discussion about how much Vega there is, we can turn on the Vega column and we can look at our strike and see, okay, the 425 strike, for an example, has $2.58 worth of Vega. And if the implied volatility value goes higher, then we'll see Vega applied. If the implied volatility goes lower, then we'll see Vega taken off. Okay. Now, when it comes to trying to trade an option, these values are not, generally speaking, going to be a part of your decision process. It's not like we're going to go in and choose one particular strike just because that Vega value happens to be better than some other strike. Generally speaking, the strikes we pick are based on where we think that option will be at expiration. Will it be in the money or out of the money? Then we think about what the aggregate value of that strike is. So in this case, we're looking at $5,700 for that strike. That's a little expensive for a single call in SPY. But it would give us that representation. Okay, so the Vega value is our way to quantify how much volatility is going to change that option's price. Generally speaking, when volatility is low, we think that it has nowhere to go but up. And on the same token, if implied volatility is really high, we think that it has nowhere to go but down. But since we don't chart implied volatility within every single option, how would we know that the implied volatility right now is near a high or is high compared to what low would be? If we don't have a graph or a chart, how do we know if the current volatility is high or low? Even without a chart, we can start to answer that question. We can look at the implied volatility average sitting on the side of the strikes, right? So if we close all of these up again and we look at the far right side, we can see those implied volatility averages. And then we can see, if we go each series closer to the money, are the numbers getting bigger or smaller? Now, in times of high volatility, you'll see what we call backwardation. And backwardation is basically saying that something right now in time is more expensive than something farther out in time. That would be backwardation. You normally hear those kind of discussions when we're talking about the VIX or maybe the yield curve, but anything that has a dollar value and time connected to it, generally speaking, is going to have some kind of curve where farther out in time, it's more expensive. So the normal curve is supposed to go up, right? And that way, things that are far out in time have a higher dollar value than things that are closer in time. When we are in that situation, when we're in normal conditions, we call that contango. And when we're not in this normal shape or normal distribution, when we're inverted, then we're in backwardation. Normally, the conversation for a piece like this would deal with the yield curve and is it inverted or not, but it still applies to other things like options. So when we're looking at this, if the series is, we'll say 29, right? You can see right here, we've got an implied volatility average of 29 for the June 6 series, 30 days to expiration. And as we scroll down through that series, we can look at the implied volatility average. Now remember, the number on the side here is the aggregate average. It's looking at all of the out-of-the-money options on the call side and the put side, and it's averaging all of those implied volatility values. But it's worth noting what the implied volatility values extremes are and what its minimums are. So we're looking at all of the contracts for the June 6 series 30 days out, and the smallest amount of implied volatility way out of the money, moving higher than the current stock price, is 1846. So what this is telling us is that if SPY was to rally over the next 30 days and go from a 410 stock price all the way up to 480 stock price, that the 480 at that point would be at the money, and that the at the money options would have around a 18.5 implied volatility. On the other side of that coin, we can say if SPY was to fall from 410 all the way down to 270, the 270 at that point would be at the money, and SPY would have an implied volatility of around 62.8. Okay? How much change in the underlying option could we expect if SPY was to make that kind of move? The Vega value gives us that answer. We can see that the at the money Vega value is around 47, and as we go lower in its stock price, the Vega value got smaller and smaller and smaller. So as the implied volatility changes, as it got bigger and bigger, the Vega value got smaller and smaller, and the farther we went out of the money, the lower that Vega value got. Okay? It's the same thing on the other side, out of the money on the call side. The implied volatility got smaller and smaller and smaller, and the Vega value got smaller and smaller and smaller. Now this should make perfect sense. When you think about what happens to SPY's aggregate implied volatility as the stock price rises, right? So generally speaking, when stock prices go up, the volatility goes down. Now that's not always true, but that's the way it normally works. And that's what we're seeing here within the options chain. So the strikes themselves are showing us that change in implied volatility, and we would understand instinctively that SPY implied volatility would drop as well. There are times in history where that's not true, right? But generally speaking, that's the way it works. So the greatest amount of Vega value is near the money, and the least amount of Vega value is out of the money. And the farther out you go, the smaller the Vega value. And as you hopefully remember from the previous videos, that means we're dealing with a distribution curve where the greatest amount of distribution is in the middle of the curve. It's in that high spot, right? If the center of that curve is at the money, we can see that the greatest amount of Vega happens to be near or at the money. Now we can use this a lot of different ways, but the main takeaway is that if we are expecting a change in the implied volatility values and we're concerned about it, then we can try to avoid those greater values by going out of the money, or if we wanted them, then we could build our trades closer to the money with an expectation that a change in implied volatility values would really benefit our trade the most if we're holding options that are near the money. There are time-based trades that we take, things like iron condors or short verticals, where maybe you've heard them called credit spreads. So in those situations, a credit spread built near the money will get a greater impact in Vega value than a credit spread built out of the money. And if you're looking for a volatility crush, say for an example like earnings, then that trade also is based on a change in volatility, and you would want the greatest amount of change in volatility that you could get, and that would be near the money. So that's it, everybody. Just a small introduction. Remember, with all of these Greek videos that we're doing in the introduction series, these are just the introductory videos. I do have advanced, complex Greek videos that are in the Next Level library under their own individual names. So you can go to the Next Level library and look up Vega or Theta or Delta, Gamma, and you will find an in-depth Next Level video going into really good detail about each one of those. I appreciate your time, everybody, and I look forward to seeing you at the next video.